Okay? So, again, what is break even? The sales volume that is just able to cover the operating expenses. Okay, so if you have $1,000 of sales generated and the cost, adding variable costs and fixed costs together also totals up to $1,000, then you know $1,000 is the sales revenue that you have to generate in order to at least not have loss. To have zero operating income, then if you go over this $1,000 sales revenue, your company will start getting profit. Okay, so sales above break-even result in a profit. That's the kind of the threshold for the business. They have to know that at least they have to make this dollar amount of sales in order to start getting profit. And this is also the threshold. If you go below it, you'll be getting operating losses. Okay, so the next few slides we'll be learning two different approaches to calculate break-even point. We'll be calculating break-even point in the events or in the units of products you sell, and also break-even in actual sales dollars, revenue. And the first approach here, income statement approach, if you recall income statement, what's the very last line you get? Net income, okay? And how do we get net income? Revenue minus expenses, that's the general idea. Okay, so income statement approach is going back to the idea of the format of income statement. You use total up all the sales revenue minus total costs. That will give you operating income. This is the general equation. Then we'll be plugging in more detail, classifying the total cost portion into fixed and variable costs. Okay, and then the next approach here after introducing income statement will be substituting certain terms into contribution margin. That will be the contribution margin approach, but both of these approaches we're trying to get to what's the break-even point in units and in sales